having a big ego, thinking you know everything when it comes to that particular stock, more often if not, is going to be the end of you.
I've seen a couple of PMs, they would hold on to a loser because they were right and the market was wrong. But they bought this stock, they bought it at 30, it went to $60 a share. They put like $250 million into this stock. They gave that analyst like $1 million bonus. Anyway, that stock's at like 17 cents now. And don't fear volatility. Volatility is your friend.
So in this video, we meet my friend Dave. Dave is a former Green Beret officer who became a Wall Street hedge fund manager spanning over 20 years of experience. A couple years ago, I helped Dave move to Thailand, and since then, he's already moved back to the States and has written a book called Don't Be Stupid, a Green Beret's Guide to Investing, where he talks about the psychology of the markets, how to embrace volatility, and knowing when to admit mistakes. So if you guys are really into finance and investing, you're definitely going to want to check out this episode. Let's go meet Dave.
So this is going to be something a little bit new. We're going to be doing a podcast episode. Back with me, I've got my friend Dave Walker back on the channel. Dave and I met in Thailand, and we did a video together talking about the importance of traveling and finance and investing. The sad part is that Dave is no longer in Thailand, not because he was in trouble with the authorities or anything, but left Thailand to go start your hedge fund. At the same time, you are now a married man. So congratulations to both.
Thank you.
So to give you guys a little quick introduction, my good friend Dave Walker. Dave is a former Green Beret who's now a hedge fund manager with 21 years of experience at a multi-billion-dollar hedge fund. You're the founder, chief investment officer of Jedburgh Advisors, a hedge fund where you focus on managing on equity long, short portfolio that invests in disruptive innovation. And you are now an author for your new book, Don't Be Stupid, a Green Beret's Guide to Investing, where you teach others how to think about investing. So very cool stuff. We'll talk more about the book and as well as your experience leaving Thailand and life after Thailand. You've been traveling for what, about a good 2-3 years before leaving?
Oh, yeah. Well, first of all, Forrest, thanks a lot for having me back. It's really great to see you again and great to talk to you again. And yeah, so we've been traveling. So my wife is Thai, which is, I met her in Thailand at a Starbucks. But anyway, so we traveled, we traveled almost straight for about 24 months. I think we went to 25 countries in 24 months. It's a little bit of a kind of a rigorous travel schedule, but it was a lot of fun, and I was able to do so because of the kind of the nomad lifestyle that I was working for other companies, but doing some consulting and some other work, and I was able to work from my laptop, and so that allowed me to do that. But you're right, I moved back to the States so I could start my firm, and also so she could work on some paperwork. But we're eager to start traveling again because we really enjoy it.
What's one of the biggest things that you would say when it comes to like your investing acumen, when it comes to the expat life, the traveling life? I mean, how has that importance of financial investment, financial acumen is played?
Yeah, so for us, when we were traveling, I was still working. And so what we would do in Europe is kind of easy because, you could get up in the morning and maybe do a quick workout or something like that, or maybe you didn't, but whatever, you could have breakfast and you could go out and see a bunch of whatever sites, tourist sites or churches or whatever, wherever, depending on the town you were in. And then we would kind of have lunch, and then we would like get back about, 1, 2 o'clock. And then the market would open in New York like 2:30, right? 2:30 Europe time. So then I could trade in the market and do whatever I needed to do, and also kind of have a full work day if I was consulting and whatnot from like 2 o'clock in the afternoon to like 10, 11 o'clock at night, which is fine for me because I kind of generally run on, 4 hours of sleep anyway. So it worked out really well. And when we traveled, especially Europe, it was a little bit more difficult when I was in Thailand or Southeast Asia, because that's about 12 hours off. So it's actually a little bit of a burden.
The hours are brutal over here.
Yeah, it's quite brutal. And I remember putting sticky notes up on the wall, counting down the days backwards when I was back in either Europe or the United States. But we wanted to come back here because I had some things to take care of business-wise, and I wanted to do some stuff for the fund, get the documents all done and get the fund up and running. And I was working for other people for 21 years, managing my own money and managing some family money and stuff for about 5.5 years. And I did really well. And so I was encouraged to go start, take that and start a fund with it. So that's what we did. We took the managed account and we started a fund.
Let's talk about your new book, Don't Be Stupid, a Green Beret's Guide to Investing.
There we go. Shameless.
Beautiful. So tell us kind of like a general intro of your new book.
Absolutely. Thanks so much. And I appreciate that. So here's how it all started. So I was working in hedge funds for 21 years in the back office. So I was never really an analyst or a PM, a portfolio manager. I was always a back office guy, meaning I was a director of ops, or I was a CFO, or a COO, or even a CCO, chief compliance officer of hedge funds for 21 years. And so being in the back office, I actually think it was a blessing, because I think you get pigeonholed when you're on an investment team sometimes, where you're focused on maybe one sector or one strategy. But I got to see a whole breadth of different strategies and different sectors, and everything from fixed income to equity long short to convertible arbitrage. We had a muni desk at one of the places I was at. I was at a commodities fund. So I got to see all these different types of investment strategies. And I kind of, slowly kind of found what fit my style the best, and that's basically disruptive equities, equity long short, disruptive innovation. Another blessing that being in the back office is I got to see an objective view of things that probably weren't going right, and I would question, like, why is that PM doing that? For example, and I was at a fund that had a horrible year and had some stocks. I was at a fund that they bought this stock. I won't tell you the name of the stock, but it went to, they bought it at $30 a share. I remember it was around $30 a share, went to $60 a share. They gave that analyst like $1 million bonus, like some 26-year-old kid, like, you're a genius. Anyway, the year ended, and that's unrealized gain. That's not real cash. That's just on paper. It went from 30 to 60. Anyway, that stock, the new year rolled over. I'm like, this kid got an amazing bonus, a lot more than I got. And they treated me really well, and I got a good bonus, but he got an amazing bonus. Anyway, so that stock next year went to 45. And I was like, I wonder if they're going to take some off the table. That went down to 30. Now they're at break even at where they were. They put like $250 million into this stock. Then it went to like $20. Then it went to 10. And I was like, holy wow, what's going on here? And I was looking at it and trying to understand it. And then it just, at that point, it's so dead. They actually started buying more. I think all in the investment was about $300 million. Anyway, that stock's at like 17 cents now. And so the lesson I learned was, Paul Tudor Jones talks about this, losers average losers, right? So as the stock's going down, people like try to start buying more because they bought a stock at 30 and now it's at 20. Like, oh, I'll buy more. My average cost is 25. Well, then it goes to 10. Well, I'll buy more and my average cost is, but then what you're doing is you're catching a falling knife, right? It's just, there's something wrong with that stock, and the market's telling you in not so many words that, hey, you may want to dive deeper. And part of my book, this is what became my book, is that all these lessons learned became sticky notes, and then the sticky notes I put on paper, and then that became like my blog, and then I realized I had like 11 bullet points of like my strategy and how I want to invest from these lessons learned. And one is like, if the stock's getting crushed, something's wrong. You're missing something, so get the fuck out. Excuse my language. I have to beep that later. And you can always figure it out later. Figure it out what you're missing. The market's got it. You don't have it. So figure it out. And while you're figuring out that stock's probably going to get crushed. One of my first rules is obviously don't be stupid. That's the very first rule, is where am I wrong and what am I missing? Because something might be going on. And so, like I said, these are just fundamental rules that I picked up over time by watching PMs either do great or maybe have some, even they were rock star PMs and they had some challenging years, because maybe they violated some sort of principle. And some of the principles are just, math based, like down draw math that we talked about earlier.
From the sounds of it, I mean, let's say if I'm, just a complete normie reading Don't Be Stupid, it seems like one of the biggest themes is ego plays a big part in people's investing acumen. And they could, more times if not, having a big ego, thinking you know everything when it comes to that particular stock or ETF or crypto, more often if not, is going to be the end of you. Would you say?
Yeah, 100%. I've seen a couple of PMs, that they would hold on to a loser because they were right and the market was wrong. The market's made up of millions of participants, right? And I don't know if you've ever seen that gumball video where like a bunch of people try to guess how many gumballs are in a gumball machine. And there's like 20 of them, and they're all way off, right? And then some kid comes along with a calculator, adds all them up, and divides by 20, and that number is like within like 0.5% of the actual number. And that's just the power of the whole collective, right? And so what is the market? The market finds a price because there's millions of people are buying and millions of people are selling, and finally they hit a price. So that's like millions of people doing data and figuring out what is that fair price at that time. And so if you're far away from the market, listen, maybe you do have some edge. Most of the times it's difficult to have that consistent edge, or maybe the market's telling you that your price might be off. And so, yeah, I've watched a lot of these PMs make these mistakes, and I made a little note somewhere and said, all right, don't do this, and that's what became my trading strategy, which became the book.
What about, is there anything more, a little bit more on the technical side? Like, you know what, like don't get too cocky, maybe take some profits off the table.
So yeah, I put a lot of trailing stops on. If a stock is working, that's fine. It can keep going up, but then maybe it comes back down after a while because it's exploited its fundamental, or it's beyond its fundamentals in some sort of way. Or there's a shift, there's some sort of shift. Either they changed something, or the macro environment changed, or a law changed, or something that changed where now it's not as favorable as it used to be. So I think trailing stops are a good way to keep safe. And the beautiful thing about trailing stop, if you don't violate your own stop by taking it off, is once it goes off, you don't feel as bad as selling it. And then sometimes you're selling a loser, right? A stock can go down, you have a trailing stop, and it feels bad for a little bit for selling loser. But then there's this weird, this is how I am. People might be different, but sometimes when I get out of a loser, I'm like, oh God, thank God. Like you feel good in a weird way, because now you don't have to like keep suffering over why is this stock acting the way it is. So, a lot of people make mistakes. They take the money out of a winner and hold on to a loser. And I think a lot of the great hedge fund managers, the multi-billion-dollar guys, will tell you to sell your losers and hold on to your winners and let your winners run. And I think that's good advice. I think Paul Tudor Jones said that, or Druckenmiller, one of the famous hedge fund guys. One of the best things retail investors can do, in my opinion, is not like practice with like real money at first. Like you can paper trade now in a lot of brokerage accounts. So I would say practice paper trading. And in the meantime, keep your money in the S&P 500. And if you can beat the S&P 500 like 5 years in a row, okay, maybe you now have an edge. And so, or you, what I call split your portfolio. So then even after that, let's say you paper trade for like 5 years, not a year, you got to do at least like 2 or 3 years, like even through a cycle. And then I think you split your portfolio. You still have your S&P 500, and like 90%. I think you and I talked about this in the S&P 500, and then 10% in what I call your dope folio, where it gets you dopamine, where you get your trading high. And if your dope folio beats consistently the S&P 500, then you can expand that to 20%, 30%, 50%, and eventually someday 100% of your, investing and trading should be you, because you're better than the S&P 500. But a lot of retail investors are worse than the S&P 500, and either they fail to admit it, or it's just too much dopamine, and they just think they're going to hit that big one. It's just like putting the money into the one-armed bandit, and they would be better served not doing that.
In all actuality, it's all about psychology. I think people are just naturally greedy, and if you were to give a percentage of the market, it's 80% psychology.
Well,
and
yeah,
people are
runs on fear, because it runs on fear and greed, right? It definitely runs on fear and greed, and uncertainty is part of fear, I guess. Yeah, it definitely does. Like the market in bad news, okay, it'll do bad. Good news, it does good. Sometimes bad news is good, but that's a different story. But then uncertainty is the worst thing for the market. It's worse than bad news, because it's like we don't know what to. But you know what it also is, Force? I agree with that. There's some greed involved, and that's why people kind of want to trade their own account. They think they're going to beat the market. I also think it's the gamification of all these, trading apps and everything. I've seen my friends' kids trading on Robinhood and little sparks fly and everything. It's like, I think that's unfortunately, could be dangerous to a lot of folks when they're doing that. So those apps, obviously, I know some of them they don't really make the money on the trading. They make the money on the margin. But either way, it gets you addicted to doing more. And when that's pretty much been proven, that the more you trade, the worse your performance is going to be. Unless you're a high freak firm, like, those high frequency firms that do.
Oh, yeah, with Robinhood, with what you just mentioned with the sparks flying, I mean, that definitely appeals towards like a retail investor's like dopamine. You're like, wow, this is like a 100%. Game, like addicted.
100%. That's exactly why it's there, and I own the stock. So because I own the stock, but I don't trade on the platform, because we have professional platforms, et cetera. But I own the stock because, I think it's doing great, and I think they get people hooked. So if you're trading like that, that's fine. But make sure your dope folio is very small, where you can still get the dopamine hit, but you're not going to lose your retirement, and you're going to be working, answering the door at Walmart when you're 85. It's so important as a younger person to really start putting money away for retirement, because the compounding of time, it's just so valuable. And I asked people, like I said, listen, the market does about 9.6, 9.9, depending on with dividends. The last 5 years has done like 12. But anyway, if you go back 100 years, and you probably, let's say if you're 25, you're going to retire at 65. You have, what's that? 40 years. You know what $100 compounded at nine, let's call it 10% in 40 years comes out to?
What does it come out to?
$4,500. That's about 45x. So if you're gonna trade that away on $100 away on Robinhood, like, oh, it's only $100. No, you just robbed yourself $4,500. Your older self. And I even tell my friends' kids who are like, hey, I'm going to buy these new sneakers or whatever and they're $300, $400, $500. I'm like, really? If you save $100 and slap it into your retirement account. So every time you buy a pair of sneakers as a 25-year-old, or whatever you buy, or whatever you're spending on your dopamine hits, look in the mirror and make sure you're fine with robbing yourself out of 45 times that money in the future.
One thing I wanted to ask you about your book is that you mentioned in the title Green Beret with investing. How would you say that your experiences as a former Green Beret officer correlate with investing?
Yeah, that's a great question. I'm glad you brought that up, because I've been asked about that. So I went back and looked at, what did I learn about being a Green Beret where I can apply to my career, a civilian career, and to my investing career. And I do apply it a lot. First of all, you got to have grit. You got to be able to kind of take it. It's a tough game. If you're going to do this full time or even part time, you're going to do it on your own. It is a tough, tough game. And you're going to take a lot of losses, a lot of beatdowns, right? So, I did really well in the Army, and I was, a lieutenant in the 82nd. And then I went to, try out for Ranger Battalion. So you kind of back down to square one. You're getting yelled at. You're a nobody. You're just a number on a hat. You go to airborne school, same thing. And then you finally make it back up. You're a platoon leader in the Ranger Battalion. Then you try out for Special Forces. All right, now you're down at the bottom again, and you're getting yelled at, and you're just a stupid number. And, so you have this rocky road, and trading and investing is very similar to that. And if it's not for the faint-hearted. It's for someone who can kind of take the beating. And especially when I was at a hedge funds in Manhattan, there's no training course. There's no, hey, read this manual. We're going to train you for 6 weeks. Morgan Stanley does that, and Goldman does that, and the bigger firms do that. But when you go into a hedge fund, it's like, here you go, figure this out. It's trial by fire. And they weren't going to break me. And some guys broke and they left and they quit. But I wasn't gonna. So the Special Forces training came in handy with the grit and just understanding that there's going to be ups and downs, and then also just having the discipline to stick to a program, right? So stick to what is working and what is good, and not trying to be like all over the map. And I made that mistake a little bit. I kind of lost my discipline for a bit early in my career or trading, when I was doing it for myself. And I finally had to kind of go back to the fundamentals, and I had to read my own notes. I don't read the entire book, but I literally have a note page from my book, and I kind of read it every once in a while, very often, just to make sure I stick to the plan. And so I think those were the two main things: the discipline, the grit, and maybe the third main thing is like having a plan. And you write an op-ord. In the military, you could frago that plan. You could fragmentation, or you could change that plan if there's slightly different circumstances. But you really stick to the plan as much as possible, because proven fundamentals are proven fundamentals throughout the history of military operations, and those are the things that I kind of tried to mix in to the book as much as possible. Maybe it doesn't have that much of it in there, but it has a couple of anecdotes where it might cross over.
To kind of caveat a little bit about what you mentioned about trading, let's say in like the more technical part, would it be better whether you're beginner, intermediate, or even advanced to just trade small? Like, don't take on too many positions?
Oh, yeah. 100% trade small. And here's another thing: when you're losing, you want to do a catch-up trade and knock it out of the park and bring it back. That is the worst thing you can do. You actually do the opposite. you go back in smaller so you can build the confidence back up and make sure your plan is working right and make sure the discipline. So yeah, I would 100% tell people to start off, like I said, start off with a paper trading account, trade paper, trade fake money, to see if the strategy works and find something that works best for you. Some people are value oriented. They love value stocks. Warren Buffett made a whole career out of value stocks. Some people are growth oriented. There's amazing growth stocks that are out there right now. And some people maybe just want to do crypto. That's a place where, I have a very small understanding. I have some, but we have friends who have a much deeper understanding and they do it full time and they don't do any or hardly any stocks. So I would say 100% start very small and or a paper and see which styles work for you.
So let's say if, you end up taking a big hit, one of your biggest setbacks, like how do you usually would get back on the horse? Obviously over trading is not recommended,
Yeah.
But I mean, can you explain like let's say if you end up screwing up on a trade and psychology as well, like how would you usually recover and rebound from that?
Yeah, that's a very good question. And I will give you a good story because when I was trading this managed account, and it was me and a buddy trading that managed account. He's still with me and as a co-PM of the fund, but we were getting beat up, and this was a couple years ago, and we were just a bit frustrated, and we were having a challenging time. We kept taking the book down smaller and smaller, our exposure, to a point where I said, Preetam, his name is Preetam. I said, Preetam, let's just. We were both also kind of doing some other things, so we weren't super focused on it. Now we are super focused, but I said, let's just go to zero. Let's just go to cash. And I'm not afraid to do that. And I think so. For example, mutual funds, they cannot do that. Here's the problem with mutual funds. A lot of them, they cannot do that. They have to stay 95% in the market. And so when the market is getting its face ripped off, they're like, hey, the market was down 30 and we were only down 25. Look how smart we are. Well, like down 25 still sucks. You know what I'm saying? So, well, the beautiful thing about hedge funds, we can go short or we can get out altogether. We can bring exposure down. We can make money in a down market where a lot of these mutual funds cannot, or even index funds, because the index is getting crushed. They're getting crushed. But I was having a difficult time. We were having a difficult time. We just took the book down to zero and we stayed that way for a lot of months. I don't remember how many months, but it was a lot. It wasn't just like 2 months, let's get back in. It was quite a number of months till the market environment changed and we changed. We had to kind of like get our heads around it. We had to be more focused. Back to your question, which is how do you recover from something like that? Is you step in small. You do a lot of research, or we did research even before coming back in, before placing one trade. We said, let's just do a lot of research. And this is, before AI and before helpful assistance. Now, I spend hours every day on AI for research, right? I say, what is this? What's going on in China? What's going on in the tariffs? What's going on? So I use like 3 or 4 different ones that bring me the news, bring me research, go deep into a stock, look at the earnings, so now we can leverage our ability to do research. Instead of hiring 4 people, we have all these AIs running and giving us information. We still make the investments on our own. Like we still like buy and sell on our own. We don't have an algo that does anything. We may open up another fund that kind of does something like that. We're experimenting with that. But we just, if we like when we got beat up and we got out all together a long time ago from the managed account, not the fund, we just slowly worked our way back in. And that's the advice I would give. Just like slowly come back in. Don't go too crazy, just to build the confidence back up.
One thing I read from your book that I thought was really cool, you have a section on like admitting that you're wrong. It may seem kind of simple saying just admitting when you're wrong. I mean, would you say that once you admit you're wrong, then it's okay to exit out of a trade and just be like, right.
Well, that is the ultimate sign of admission when you push the sell button on a losing trade. You're like, there's no better sign that tells the world that you were wrong when you hit the sell button. But listen, I mean, my second book, I wanted to do I think admitting you're wrong is a superpower. I really do. The natural human instinct is to defend, right? Somebody attacks you with a knife, you defend. All animals, plants defend each other. They fight for the sunlight. This is just the nature of living beings. We all fight each other. That's just the nature of things. So when somebody says something to you, your first instinct is to defend. And it's very difficult. It goes against human nature, goes against animal nature to say, you were wrong. And then they make fun of you. Oh, you're admitting it because then you're, like somebody. Listen, man. I've tried some things, and I won't tell you the story about it. But somebody was trying to make fun of me because I was wrong about something, and I was like, yeah, I was wrong, and you know what? I learned from it. So you kind of have to to get around your ego a little bit. You can say, listen, you're making fun of me. All right, whatever. But here's what I learned from it. And here's why I'm better now because of it. And then they start getting a little bit quieter and they go, oh, wow, maybe I shouldn't be making fun of this guy. There's a famous Soros story. Again, whether you like his politics or not, it's irrelevant. I'm not a political guy, but George Soros is one hell of an investor. And the story goes something like this. I'll butcher it, but he was playing tennis with a guy. And the guy asked him, what do you think is going to happen in the market next week? There's all these earnings and all this stuff's coming out. He said, yeah, I think the market's going to go down, blah, 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 blah. Anyway, they finish their tennis match. They go back to their offices. The Monday opens up. The whole week goes by. The market just was been ripping. And so the guy calls up George Soros and says, hey, like, I know you said that you were going to short the market. The market was down and sorry to hear that you probably got beat up. He goes, no, I was wrong. I'll admit I was wrong. Halfway through the week, I started realizing I was wrong. I did more research and I flipped my position back to long the market. And, it came out at break even. I didn't lose some money, and admitting I was wrong, that saved me instead of continuing to fight the market. So it truly is a superpower, and it goes against human nature, goes against animal nature to admit you're wrong, especially in front of people or in front of fans, because their next inclination after you admit you're wrong is to make fun of you, to try to bruise your ego even more. And so you got to kind of take that and say, yeah, you're right, and I know you're making fun of me, but here's what I learned, And it helps your investing, because getting out of a stock when it's down 20 is a hell of a lot smarter than getting out when it's down 50. And then you really have to admit you're wrong. Some of the best portfolio managers had big egos, but they're also the ones that when they blew up massively. And I think it is probably driven by that inability to admit you're wrong.
Dave, you've got decades of experience working in the New York markets. What's your take on crypto? I mean, do you feel like there's some correlation of it? The things that you talk about in your book, can that be translated over to crypto as well too, even though crypto can be a bit volatile and a bit crazy?
Yeah, one of the chapters in my book is, so I read a book years ago, and this guy talked about, I'll sum it up for you in 3 sentences. He said, trade what you know, trade it more often, trade it in size. And I said, that can't be right. I said, I think 2 of them are right, but I don't think the middle one is right. I think you trade what you know 100%. If you know a sector, like I got a buddy who's an oil guy. He knows oil upside. He can tell you the SPR is full or empty right now. He can tell you the price in the sand, the Canadian sands versus he can tell you anything about oil. He trades oil. That's what he does. That's his shtick. He's an energy guy, does other energy. Not my thing. I don't do oil. So my philosophy is trade what you know, wait for a setup, and then trade it in size. And what I mean by a setup, there's a time when a stock or an asset is going to be more favorable. And Warren Buffett can wait decades. He'll wait for a decade for a stock that he likes to go down to a price that he likes, and then he'll buy it, right? So he's got an enormous amount of patience, and it's such a great such a great skill set, characteristic to have. And so I think for crypto, if you know it and you studied it and you read it. So my first foray into Bitcoin was in, I think, 2013. A friend of mine, I was playing poker with him. He was like, I'm buying this Bitcoin stuff. And he bought it like $126 and he sold it at like $1,000. Like the next day I went home and I ran out, and Coinbase had 3 crypto, Bitcoin, ETH, and Litecoin. That was it. That was only, and I got on, I logged in, I made an account, and I bought Bitcoin at like just over $1,000. And then 6 months later, it was at 500, and I go, I must be an idiot, and I sold it because I didn't really know what I was doing. So I figured I'd buy one and see what happens. Well, it turned out I was an idiot for selling, right? Years later, in 2016, 2017, I get back in, I start buying it at like 4,000, and I'm selling it like 16,000, thinking I'm a genius. Look at that, I 4x my money. Turns out I was an idiot the second time. Then I started reading the Bitcoin Standard and Broken Money and all these great books about Bitcoin. And then I started putting it together in my head. And there's a moment in your head, and Michael Saylor talks about the 100 hours. I don't know if I did 100 hours. I might have done 200 hours. I might have done 50. I have no idea. But I did hours of research. Your head will literally just snap, and you're like, holy shit, I get it now. Right now I get it. And not all crypto is like that. I mean, Bitcoin, I get Bitcoin. And then you have to get all the other ones. Well, what's ETH? What's its, where does it fit? What's Solana? What are all these other ones? All these, what are the meme? Okay, what's the thing to get about them? What do you get about NVIDIA? Do you get NVIDIA? right? You get Tesla. Like, is Tesla a car company? No. If you think of Tesla as a car company, you haven't, you don't get it yet. You don't see what they're really doing. What's their future? Robots, AI, energy, solar, like all these trillion-dollar markets. Okay, now I get Tesla, right? It's not just a car company. It's a car company and all these other things. Same thing with cryptos. You all the crypto. If you get each one of them and done the research on each one of them, I would say, yeah, you could probably apply very similar strategies in that I talk about. Trade what you know, wait for a setup, and trade it in size. So I think that chapter certainly applies. And I have some, and I have some that I'll hodl forever. You know which one that is, and it's a very
Oh, yeah.
small amount. It's a very small amount. So please don't send any kidnappers and cut off my finger. Not worth it. Too small. And then I have a few that I kind of like, waiting for the kind of the cycle and this, that, and the other. We'll see. We'll see what we do with that. But I want to open up some other funds, so I don't know if I'm going to bring that across into some sort of like algo trading fund or something. We'll see. We'll see what we're going to do with that.
Yeah, I can see sometime in the future you're going to have like a fund specifically for crypto, or if you want to long, short, or
Yeah,
if you want to just.
we built Jedburgh Advisors as more like a platform where we can have multiple funds on it, because I was a back office guy, so I know how to build these things, right? And I know how to build it super cheap, right? So like I said, I travel and I do it from my laptop. I don't have these big offices and big servers and it's much more expensive now, especially if you know what you're doing, how to set up a fund. And we built it so, let's say if somebody wants to, like a trader says, hey, listen, I got this strategy and it's making me money, and I have 500K or $1 million, and I'd like to launch a fund, but I don't know how to do any of this back office crap. I don't know how to do the compliance. I don't want to get in trouble. I just filed some stuff with the SEC 2 days ago because they have a whole new system. Like, it's a pain in the ass, right? So they want to come and they want to launch on our platform. We would be happy to launch under our umbrella, because we have the SDV, SOB, the Service Disabled Veteran Owned Business. We can launch a Jedburgh fund. I would love to have 12, 24 Jedburgh funds, all different kinds. We can do value, we could do macro, we could do crypto, we could do privates, all under the big umbrella, so that we have a lot of different funds. And then the manager would get like the whole meat and potato, and he'd pay a small price to the house, so to speak, like a rake. And we're to the house to do all the back office crap
Yeah.
work.
Sounds like a wonderful business opportunity.
Yeah, we hope. We'll see. We'll see.
What is your opinion when it comes to volatility? Most people, like when I first started out, when I see volatility, I freak out. I'm just like scared shitless.
Yeah, yeah.
But most experienced traders and most experienced investors don't see volatility that way. Volatility is your friend.
I agree with that, and volatility. So you're right. Even a lot of institutional investors are kind of afraid of volatility, right? So they have a different view of volatility, because maybe they're running a pension fund or something like that. They can't afford volatility. They can't afford to. They'll lose their job. But volatility is an investor's friend. You want a stock that you love to go down so you can buy it. You want a stock that you love to go up if it's going up and down. But you also want volatility, because volatility is mean reverting. And we have our friend Evan, that's his whole trading strategy. We know the volatility, if the market freaks out, it's going to settle down. It's going to relax. It's going to come back down, right? And if everything's great for a long time, you're like, all right, something's going to happen eventually that's to send the market into a little bit of a titsy. But here's how I look at volatility, right? So say you have two football teams, right? And they're, the coaches are across the gridiron at each other, and the one team scores a field goal the first quarter, a field goal the second quarter, a field goal the third quarter. Second team hasn't scored anything at all, right? That first team then gets the last field goal, or a field goal the fourth quarter. So they put up three, and three. They put up 12%. Or I'm sorry, 12 points, right? Very smooth, very nice and smooth, right? The second coach throws two Hail Marys at the end, and gets two touchdowns, and does the point afters and gets 14 points. So he has a very volatile scoring. He's got 0, 0, 0, and 14. But who gets the Gatorade bath at the end of the game? The guy who has 12 points, or the guy who has 14 points? So that's why volatility, and if you look at really good traders, even Warren Buffett says the same thing. It's about, there's a quote about volatility. I'll butcher it. I think it's on my website. But he said something about it's a misnown concept, misunderstood concept, and it's not taught well in business schools. They talk about Sharpe ratio, and Sortino ratio is a little bit better, but it's not a good way to kind of measure your how you're doing. Because like my fund is pretty volatile, but it's put up high risk adjusted returns. I'm allowed to say by law. And the SEC kind of doesn't allow you to say the numbers, but they're very good. Um, but it's lumpy, And so even Warren Buffett said, "I'll take a lumpy 15 over a smooth 12." And if you do that math and you compound that over time, the outperformance is earth shattering. In fact, it is on my website. I put a smooth 10 against a lumpy 16. And what I mean by a lumpy 16 is and this is for 3 decades, and if you go up 16% and then you have a down 25 year, down 25%, and then continue on and have 3 down 25% years in the 30 years, but it's 16% all the other years, and the other fund does 10% every year. Who do you think wins? I'll just go right to the answer. The 16% with the negative 25, 3 years of negative 25, outperforms by 33%. It's a third better. And you wouldn't think so because the negative 25s you think are really horrific, especially after you've gone 16, 16, negative 25. It's like it still outperforms massively. Lumpy beats smooth, and don't fear volatility. Volatility is your friend because you want things to be volatile because that's when you can get in at better prices and things can go up, and then maybe you can hedge or take a little off the top or put a trailing stop in or sell covered call. You can do stuff even when it's volatile up. And so we don't fear volatility. We like it.
Embrace volatility.
Embrace it. There you go. Yeah.
Dave, thank you for taking the time out of your busy schedule to, just talk about all kinds of things, especially investing, trading, and having some financial discipline and financial acumen. Anything you want to say over on your part?
I want to thank you very much for your friendship, your fellowship, and for being such a great a friend. And for when I went to Thailand and I lived there for a bit, and for really kind of showing me around and getting me kind of into the community a lot faster. So we'll be back in a couple of months. We don't know when, maybe early next year sometime, to visit and say hi. But I want to thank you for having me on again. And I really appreciate it.
I appreciate our friendship. And thank you so much for, just getting me more in depth into the world of finance and investing. I'm going to link Dave's book. I'm going to provide an Amazon link to his book, Don't Be Stupid, a Green Beret's Guide to Investing. So definitely check it out. It's a great read. It's easy to read because it's very candid and it's a very no BS approach on investing in finance and not to be an idiot or not to be stupid.
And listen, I don't make a dime off the book. All the proceeds are going to the Green Beret Foundation. I used to be a Green Beret, obviously, and I was on the board of the Green Beret Foundation. So it's all going to a really good charity. So it supports a good cause.
It's a wonderful nonprofit. You're still on the board, yeah?
I'm on the board of I was on the board. Now I'm on. Not the decision making board. I'm on the board of advisors now.
Board of advisors. Gotcha. It's a wonderful nonprofit. It's going to a good cause. So definitely check that book out. I'm going to provide the link to the book again in the description down below. Thank you so much, Dave. And check his book out. Appreciate you guys. Thanks for watching, and see you guys in the next video. Take care.